Hey everyone, welcome back to the channel. Get ready, because today we're diving deep into some seriously turbulent waters. The Nasdaq is teetering on the brink of a correction, and let me tell you, the stakes are high. Are we about to see a major market shakeup? Could this be the start of something much bigger? The data is flashing some serious warning signs. Stick around. We're going to break it all down and give you the insights you need to navigate this uncertainty. This isn't just about numbers. This is about your investments, your future, and the global economy. So buckle up. This is going to be intense. All right, let's get right to it. The Nasdaq Composite is nearing a grim milestone. It closed Monday's session a whopping 9% below its record close set back in December. That puts it dangerously close to correction territory, which, as you know, is defined as a decline of more than 10% but less than 20% from a recent high point. Now, here's the kicker. Other major indexes aren't feeling the pain quite as acutely. The S&P 500 is down about 4.8% from its record, and the Dow is only 4.2% off its peak. So what's going on with the Nasdaq? Why is it lagging so far behind? That's what we're going to unpack. One of the biggest reasons for the Nasdaq's underperformance is its heavy reliance on technology stocks. And right now, global trade tensions are soaring. Remember those increased U.S. levies on Chinese imports that just took effect? And the tariffs on Canadian and Mexican products? China and Canada have already retaliated, and Mexico is planning their own measures. This trade war is hitting tech companies especially hard because many of them rely on components and products from China to build their goods. Think about Apple, for example. They not only source a lot of their materials from China, but they also generate a significant portion of their sales there. Tariffs are a double whammy for them and other tech giants. It's a real pressure cooker situation. And speaking of tech giants, let's talk about the Magnificent Seven. These companies were the darlings of the market last year, but now they're struggling. NVIDIA, the poster child for the AI rally of 2024, is down a staggering 15% year-to-date. Tesla, another member of the Magnificent Seven, has plunged almost 30% during that same period. Even giants like Microsoft, Apple, and Amazon have seen their stock prices fall. Why? Well, partly it's those tariff worries we just talked about, but it's also because investors are taking profits after last year's incredible run. They're looking at the economic uncertainty and thinking, maybe it's time to cash out. This profit-taking is adding even more pressure to the Nasdaq, pushing it closer to that dreaded correction. February was a brutal month for the Nasdaq. The tech-heavy index ended the month down a hefty 5.5%, marking its biggest monthly pullback since September 2023. The S&P 500 and Dow also suffered declines, but the Nasdaq took the brunt of the selling pressure. This downturn was fueled by the same concerns we've been discussing: global trade uncertainty and its potential impact on economic growth and corporate profits. President Trump's threats of additional tariffs on Chinese imports and the retaliatory measures from China, Canada, and Mexico have created a climate of fear and uncertainty in the market. Investors are on edge, and that's reflected in the market's wild swings. Andrew Brenner of Nat Alliance Securities put it bluntly: the Trump put is fading. He pointed out that a significant portion of the rally since the election has now reversed, with a majority of the S&P 500 down since the election. He added that the tariff rhetoric has become daily and extreme, creating awful sentiment and edgy trading conditions. Remember the market reversal we saw on Thursday? The major averages started the day strong, but then plunged sharply lower toward the close. That's a clear sign of the anxiety and uncertainty gripping the market right now. Investors are reacting to every headline, every tweet, and every trade announcement with extreme sensitivity. Ulrika Hoffmann-Burchardi of UBS summed it up well, saying that investors have had to contend with a barrage of fast-moving headlines. The Federal Reserve's signal of a slower pace of monetary easing, sticky inflation readings, the emergence of low-cost AI models, weaker consumer confidence, and elevated geopolitical uncertainty. All of this is weighing heavily on investor sentiment. Data points are showing that investor sentiment is poor. But here's the important thing. UBS still believes that the bull market is intact and that U.S. equities will end the year higher. They're cautioning that volatility is likely to be higher this year, but they're not calling for a major market crash. That's a crucial distinction. So what's next? Well, history suggests that Wall Street could get a seasonal reprieve in March. Over the past 20 years, March has been a stronger month than January and February on average, according to S&P 500 return data. However, Christopher Mistal of Stock Traders Almanac warns that March tends to be softer in post-election years. He also notes that the Nasdaq tends to underperform the S&P 500 during post-election March periods. In other words, don't get too optimistic just yet. There are also plenty of potential market-moving events on the horizon in March. The latest non-farm payrolls report and the Federal Reserve's meeting to discuss potential interest rate changes. These events could significantly impact the market's direction. Bank of America is warning that the S&P 500 is historically pricey right now. Equity and quantitative strategist Savita Subramanian said that the S&P 500 is more expensive than average based on 19 out of 20 indicators tracked by her team. That includes a forward price-to-earnings ratio that's almost 40% above the historical average and an enterprise value-to-sales ratio that's two-thirds higher than the long-term trend. But here's the twist. Subramanian believes that the Trump administration's push for deregulation could clear a path for the market rally to continue. She argues that this potential deregulation is not yet reflected in stock prices. Subramanian points out that industries that stand to gain the most from deregulation are those that are most heavily regulated. She highlights consumer goods, commodities, financials, and transports as areas that could benefit from lighter regulation. She also notes that there's a strong inverse relationship between the number of regulations and forward P/E ratios. The more expensive a stock, the less regulated it tends to be. A loosening of the M&A backdrop could also benefit financials from a fee perspective while boosting returns on capital in less expensive, fragmented sectors like staples and small to mid-cap healthcare. This deregulation angle is something to watch closely. While the stock market is facing uncertainty, there's a rush for gold happening on Wall Street. Gold exchange-traded funds saw record high inflows last week, led by the SPDR Gold Shares ETF, GLD. Gold prices are at all-time highs, boosted by trade uncertainty and inflation concerns. George Milling-Stanley, chief gold strategist at State Street Global Advisors, said that gold thrives on uncertainty and that the recent surge in gold buying was prompted by increasing concerns over the outlook for the U.S. economy. Gold futures are up more than 10% for the year, far outpacing the S&P 500's advance. Milling-Stanley added that the influx into gold has occurred as appetite for risk grew dramatically during 2024, pushing investors to hedge against those positions. He noted that FOMO, or fear of missing out, could be driving individuals to rake up shares of gold. Jurian Timmer, director of global macro at Fidelity Investments, said that gold has been a big winner for the past few years, keeping up and even beating equities. He also pointed out that gold has produced almost the same return as the S&P 500 since 2020, while having lower volatility. Timmer sees gold as a hedge against bonds, particularly when bonds are impaired. This flight to safety is a clear indicator of the anxiety in the market. Despite all the worries about President Trump's trade war, some analysts believe that companies are choosing to focus on upcoming tailwinds, allowing investors to largely shrug off tariff concerns. Goldman Sachs chief economist Jan Hatzius said that animal spirits over tariffs is the takeaway from this earnings season. Excluding results from energy companies, real revenues in the fourth quarter have gained 3.2% year-over-year due to resilient consumer spending. Hatzius also believes that a more lax regulatory business environment under the Trump administration is boosting corporate optimism. This optimism is fueling business investment and capex expectations. However, Goldman Sachs is also worried about a correction due to higher valuations and a less friendly macroeconomic policy. Christian Mueller-Glissman, managing director of portfolio strategy at Goldman, said that they are tactically worried about equity correction risk, which has picked up due to higher equity valuations, less friendly macro momentum, and higher policy uncertainty. He believes that the tit-for-tat tariffs between the U.S. and its key trading partners are likely to result in more market uncertainty. Goldman is focusing more on hedges against any market downturns, using securities such as option overlays, the dollar, and gold. From a technical perspective, Katie Stockton, founder of Fairlead Strategies, believes that the S&P 500 may have reached a new all-time high, but the technical setup spells trouble ahead. She expects a pullback of 5% to 8% could soon be at hand. Stockton cites a deterioration in market internals that suggests that stock's comeback following this month's softer inflation numbers has run its course. She expects that stocks are currently in the second phase of a three-part correction. Using the Elliott wave theory, she expects that stocks are currently in the second phase of a three-part correction that determines the direction of a market trend using price movements. Another indicator, the McClellan oscillator that tracks market breadth, shows this latest move higher is overdone. Stockton expects the S&P 500 could find support around 5,783, or roughly 5% below where the broad market index was trading. Canaccord Genuity also believes that market volatility is likely to continue moving forward and that the S&P 500 could see more near-term pressure ahead as a result. Analyst Michael Welch said that because there are plenty of market-influencing events unfolding this week, with roughly 97 S&P 500 companies expected to report through Friday and Wednesday's Federal Reserve interest rate decision, uncertainty is likely to persist. He also listed Thursday's reading of the fourth quarter U.S. gross domestic product and Friday's personal consumption expenditures price index report as other important data points for the market this week. In short, buckle up, because the ride is likely to be bumpy. So what's the bottom line? The Nasdaq is definitely facing some serious headwinds right now. Trade tensions, struggling tech giants, and investor jitters are all contributing to the decline. While some analysts believe that the market can weather the storm, others are warning of a potential correction. The key is to stay informed, stay vigilant, and be prepared to adjust your investment strategy as needed. Remember, market volatility is a normal part of investing, and opportunities can arise even in challenging times. What do you think? Are we headed for a correction, or will the market bounce back? Let me know your thoughts in the comments below. And don't forget to like and subscribe for more in-depth analysis of the market and the economy. Thanks for watching.